Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. Market update: the shift to verification. This video presents a direct informational narration of the source document. So we're unpacking a crucial document today detailing what's shaping up to be literally the busiest week of the year for April 27th. We're talking major central bank rate decisions from both the Federal Reserve and the Bank of Japan, alongside roughly 44% of the S&P 500's market capitalization reporting their earnings. And, despite these massive impending events, market optimism has remained surprisingly resilient.
Okay, let's take a look at our agenda. We've got 6 key areas to cover today. We'll start with macro events and geopolitics, then move into market breadth divergence, tech giants verification, a specific semiconductor short strategy, central banks and yields, and finally, corporate developments. Let's dive right in.
Starting with Section 1, Macro Events and Geopolitics.
Right now, the market is anxiously waiting for some substantive progress between the US and Iran. Over the weekend, the U.S. actually canceled a trip to Pakistan. Now, while there hasn't been a definitive escalation, it definitely resembles a pause in negotiations. Iran has proposed a 3-stage plan, communicated via Pakistan. Stage 1, it's all about ending the war and securing guarantees against renewed hostilities toward Iran and Lebanon. Only then will they move to Stage 2, which is managing the currently closed Strait of Hormuz. And Stage 3, nuclear talks. But Iran is drawing a really hard line here. They're insisting that those nuclear discussions absolutely will not happen until the first 2 stages are successfully resolved.
And you can see the immediate pressure this puts on global energy markets. Goldman Sachs just upgraded their oil price forecasts, noting that risks are heavily skewed to the upside. Get this, global oil inventories are depleting at a record pace of 11 to 12 million barrels per day. Because of this, the timeline for the normalization of Gulf exports has been pushed back from mid-May to the end of June. Goldman's current baseline assumption estimates a 70% recovery by July and a 90% recovery by year-end.
Moving on to Section 2, Market Breadth Divergence.
Now here is a truly fascinating disconnect. The technology sector is pushing indices to all-time highs, but underneath the surface, there is severe weakness. Even as the broader indices climb, we just saw the second worst market breadth history during an index high. 324 components closed down, with a net breadth reading of -148. Essentially, this means upward momentum is resting on the shoulders of just a few heavily weighted stocks, while overall market participation is actually shrinking. Historically, when we see this kind of structural divergence, where the index goes up while individual components fall, it's a massive red flag. It usually precedes high-level consolidation or a coming correction. However, based on historical patterns, indices can often coast higher for several days on momentum before a correction is actually triggered. Which brings us to Section 3, Tech Giants Verification. This shift from pure expectation to verification leads us to the absolutely crucial upcoming earnings for the Magnificent Seven. And this will dictate if the NASDAQ 100 targets the 28,000 level or drops to the 26,000 support zone. Last quarter, everyone wondered if AI demand could support the massive infrastructure investments. Now, continuous model advancements have kind of cooled that debate, and these companies have to prove it. For Microsoft, it's all about monetizing Azure and Copilot. AI must now be a core revenue pillar. Alphabet is dumping 60% of its capex into infrastructure, so the market is hawkeyeing their search moat and cloud momentum. Meanwhile, Meta's staggering $135 billion capex is seriously testing investor patience. They require stable ad revenues to offset that spend. Amazon is focused on shortening the return cycle on AWS. Apple remains a bit of an outlier, tied to iPhone demand, macro resilience, and supply chain shifts. And NVIDIA, well, they remain the ultimate industry barometer. The market is watching closely for custom chip competition and any signs of diminishing marginal returns on AI demand.
Let's look at Section 4, Semiconductor Short Strategy.
Following a massive 18-day winning streak for semiconductors that just ended with a 1% drop, we're seeing some wild sector rotation. An investor identified in the document as MB is betting big that funds will rotate out of a hardware bubble and back into beaten-down legacy software names like Adobe and PayPal over the next year. This is a direct rejection of the mainstream narrative that AI is going to destroy software as a service, or SaaS. Now, while the broader logic of sector rotation makes sense, shorting robust leaders to buy into fundamentally weaker stocks is certainly a bold and highly debated move.
So, how is he executing this? Well, by purchasing iShares Semiconductor ETF,
or SOX, put options expiring in January 2027 at a $330 strike price. That implies he's anticipating a 28% drop from current levels. He clearly believes this recent chip rally is driven by technical hype and the mainstream narrative of data center chip shortages rather than underlying fundamentals. And to double down on this strategy, he also purchased long-term put options on NVIDIA and the broader QQQ index.
Moving on to Section 5, Central Banks and Yields.
Let's see how this builds into the broader macro picture. U.S. Treasury yields are persistently consolidating around 4.3% ahead of the Fed's rate decision. Rates are fully expected to remain unchanged, meaning no new economic projections, but the market's eyes are glued to Chairman Powell for a totally different reason: his tenure. If Powell leaves early before his January 2028 term ends due to DOJ-related issues, it opens the door for Warsh to take over as chair. This could potentially enable a formal appointment for a Trump ally to a vacated board seat, shifting the committee to a much more dovish stance. Honestly, that potential departure is triggering more yield volatility right now than his forward guidance. The market is only pricing in about 10.5 basis points of rate cuts for the whole year, which is a massive cooling of easing expectations since February. And just briefly, regarding the Bank of Japan, the probability of a rate hike has significantly decreased recently, so minimal market reaction is expected there.
Finally, Section 6, Corporate Developments. Let's start with the sudden collapse of POET Technologies. The stock nearly halved in a single day after Marvell Semiconductor canceled all Celestial AI procurement orders. Why? Because of an alleged confidentiality breach regarding purchase orders and shipping information. This effectively wiped out a massive rally where the stock had tripled from $5 to $15.50 in less than a month. But the timeline is highly suspicious. POET received the cancellation on April 23rd, yet the stock surged 29% on April 24th before violently gapping down. There is heavy market skepticism here, with many wondering if this confidentiality breach is just a convenient excuse masking underlying technical failures with the product. Meanwhile, Qualcomm shares saw a wild ride. They spiked nearly 14% pre-market before fading to a 1% gain by the close. This was driven by a supply chain report from analyst Mankey Chico, detailing rumors that OpenAI is partnering with MediaTek and Qualcomm to build a mobile phone chip with Luxshare as the manufacturing partner. But keep in mind, with mass production estimated for 2028, this is purely a speculative narrative right now, not confirmed orders, which is exactly why early investors quickly secured their profits. In major AI partnership news, Microsoft and OpenAI are shifting from an exclusive, binding relationship to a more open, non-exclusive model. A revised agreement reveals Microsoft no longer holds exclusive rights to OpenAI's intellectual property. This allows OpenAI to license its technology to other partners, though Microsoft does retain licensing rights until 2032. This ends Microsoft's revenue-sharing payments, though OpenAI will continue capped payments to Microsoft until 2030, which are decoupled from technical milestones. Strategically, this transitions Microsoft from holding a monopoly right to simply a priority cloud right on Azure. It's a slight short-term sentimental negative, but they undoubtedly remain an undisputed AI leader.
Looking at the energy sector, nuclear reactor developer X-Energy went public on the NASDAQ. Backed by major investors including ARK Invest and a massive 29% pre-IPO stake from Amazon, the Maryland-based company surged nearly 27% on its Friday debut and followed that up with another 23% gain today. Finally, taking a look at the consumer side, Domino's Pizza stock fell after missing Q1 earnings expectations. Earnings per share came in at $4.13, missing the $4.28 mark, and that's down over 4% year over year. Even though revenue grew to $1.15 billion, it still fell short of market consensus. Why? Because broader inflationary pressures are simply forcing consumers to eat out less, hurting same-store sales. Despite this, leadership maintains the company is well-positioned for scale and profitability in this highly competitive environment. So as we progress through this vital earnings season, the ultimate question the market must answer is this: can all of this massive AI capital expenditure actually translate to verified, sustainable returns? This transition from pure expectation to hardcore verification is going to be the defining theme for equities moving forward. What do you think about this shift? Let us know in the comments below.